Hey everybody, welcome to the Lifetime Real Estate Advisors podcast. Today is December 15th, 2023. And today we are going to talk about reverse mortgages. They
Oh,
are the, yay, they're the ugly duckling of real estate a little bit. They came out of the gate kind of ugly when they were first introduced, and they've grown into this beautiful swan. That sounds kind of funny, but it's true. And I want to start off with a story on how effective they can be because there's a lot of misconceptions out there, but they really do help a lot of people. And the story I have is about, I'm not going to share her name, obviously, but there was a lady we were working with who was in her mid 70s, and she was working as a greeter at Walmart. And you could tell she had Alzheimer's that was advancing. She was trying to hold a pen. It hurt and she was shaking. It was really hard. And she felt like she was going to have to work until she died. And once we introduced the concept to her and really introduced, hey, here's what a reverse mortgage can do, then she sat there for about 20 to 30 seconds. You could just see the gears turn and it's like, I don't have to work anymore. And you could just see the happiness that brought to her, and she could spend more time being with grandchildren. And it was just a magnificent thing that really helped her out. So I think
well,
they're
I think about
fantastic.
that, and sometimes the reputation that reverse mortgages have is that you'll have less equity when you move or pass away. And it's like anybody who cares about it, that in that kind of story is just wrong about that, right? You think about your situation with your parents or I mean, obviously our parents are the same, but I'm talking to listeners. Like if your mother or grandmother could stop working at 75 but she had to use some of the equity in her home to make ends meet, like, who would be against that? That's what a reverse mortgage is for. It's the only way to access the wealth that's sitting in your home without selling it or getting a traditional mortgage that would therefore have payments, if you could even qualify for that at that age when you don't have maybe significant enough income to qualify for that mortgage. Because a reverse mortgage doesn't require payments, they're much less interested in your income than they would be on a traditional mortgage because there's no payment to make. It's just
Yeah, they're beautiful things and so vastly misunderstood. Can we talk about some of those myths? Like one I hear a lot is the bank will own your home if you get a reverse mortgage,
Yeah, the easiest way
right?
to think about that, and you know this, of course, but it's just like any other mortgage. If I have a mortgage on my home, a traditional mortgage, the bank doesn't own my home. They just have a lien for the amount of money that's owed on that mortgage. And a reverse mortgage is no different, and it's never been different, actually. That's the way they've always worked. They don't want to go on title of the home. That would make it an asset on their books. That they don't want that either. There's just a lien on the property. If you have a reverse mortgage, this is another weird thing that is commonly misunderstood. It's just a line of credit on your home. And so you don't even have to run up your balance. There has to be like a couple $100 balance on there. If you pay it off completely, it will close, but that's minuscule. That's immaterial. But you don't have to run up a balance on your line of credit. It's just a line of credit. So if you have a balance, then there will be something owed if you sell the property because there's a balance on that line of credit. If you don't have a balance on that line of credit, then there won't be anything owed. It's just a line of credit. And when people oftentimes when I explain that, people go, oh, I didn't understand that. I need to rethink how I'm thinking about this in general anyways, because I don't like the term reverse mortgages. I use it because it's so ubiquitous, but it gives a false impression or a false understanding of what they really are. They're not a mortgage in reverse. It's just different. It's a line of credit with three unique features. It doesn't require a payment. Most people know that. The credit limit itself grows, guaranteed regardless of the value of the home. It's got a guaranteed growth on the credit limit, and it's non-recourse. So I can't, if I max out my credit line and I live till I'm 104 years old and my house doesn't appreciate it, maybe I just hit a really bad real estate market. Is it possible that I get into a position that we would call upside down, where I owe more on the property than the property is worth? That is plausible. It could happen, especially if I live a long time and the real estate market just stinks. That it's a non-recourse loan, meaning they can't come after me for that difference. If I sell the house, they're going to take as much of the proceeds as they can to pay off that. But I could be theoretically $500,000 upside down on that property, and I would not owe that difference.
And that's one of the biggest key features of these is if you're upside down, if you're underwater on this mortgage, say you have a $400,000 house, and when the owner leaves the home permanently for whatever reason, there's a $450,000 loan on it. Nobody owes that extra $400,000. That's wiped away. That's part of the elements. That's part of the FHA insurance on a HECM, or that's one type of reverse mortgage, the most popular by far, of course. That's one huge benefit of it. like, I'm going to be up and downside down. I'm going to owe money on it myself if I inherit it like that. Why would anybody want that? But that's simply not true.
Yeah, and it's not quite right to say that nobody pays that. There's an insurance pool that is set aside for that purpose because there's over 1 million of these have been written in the United States. It is plausible that somebody's going to get upside down somewhere, so that insurance pool exists to make this a sustainable thing for the financiers.
Right.
Another interesting point is that's very unlikely to happen anyways, because these are relatively low loan to value credit limits. So you're not going to get a 95% loan to value on a reverse mortgage. We don't call it loan to value in the reverse mortgage world. We call it principal limits, but they're not going to be 95%. They're going to be 33, 35, 40%, depending on your age, depending on interest rates. So it's not nearly that high. There's a decent sized buffer of equity that they must have if they're not going to make you make a payment. They want to make sure there's plenty of equity. They're going to assume some appreciation on the property as well. But it is conceivable that it could get upside down if you max out the balance for a very long time and the real estate market is soft. It's conceivable that somebody could get upside down, but that wouldn't be their problem. It wouldn't be their spouse's problem. It wouldn't be their children or beneficiaries' problem. That difference is wiped out by that insurance pool. It's paid by the insurance pool.
Yeah, and even if the heirs do want that house for sentimental reasons, I mean that's usually quite rare. Usually when somebody passes away of old age, they're advanced in years. Somebody who's 80 years old might have children who are in their 40s and 50s,
Yeah.
right? So they are typically well established. They're living already where they want to live. They want whatever assets are out of that house. They don't necessarily want the house, but if it is a sentimental value, something they want to keep in the family, they can even if it's upside down, they have the option to purchase that home at 95% of the appraised value, even if it's super deep underwater, which, as we've already mentioned, is rare. So if they want to keep that in their, if they want to keep that house in their family, yeah, they're welcome to do that.
Yeah, so like it's funny this topic when I find myself explaining to people how it is, I usually go down the track of like sometimes people will want to call it's like a mortgage except this, or it's like a HELOC except this. And I prefer just to build it from the ground up. Let's just talk about what it is and not try to compare it. Let's not try to say, this is like a duck except this. Let's just call it, hey, this is a swan, it's a different animal. So it's a line of credit that doesn't require payments. It's got an increasing line of credit and it's non-recourse. Those are kind of the gears of determining how it works. But when you consider how it works and what we've been talking about, how flexible it is, how it's non-recourse, how there's that insurance pool, how the spouse is protected. So if I'm married and if I'm married with a reverse mortgage and I pass away, 90 something percent of the time, my spouse is on the mortgage with me. If the spouse isn't on the mortgage as a borrower, there's protections for her as well. I say her because I'm
Yeah.
married to a woman, but this would be true if the woman predeceased the man. If they're both on the loan, then nothing happens when one passes away, just like a traditional mortgage. If I pass away and we're on the mortgage together, nothing changes, reverse or traditional. But if I'm the only one on the mortgage and she's not, that would be a problem. So most of the time, and in the high 90s, both spouses are on the mortgage anyways. And when that isn't the case, there's protections in place anyway. We can talk about more detail on that later. But the bottom line is when people realize how flexible and how the purpose for these being built, which is to allow people to stay in their homes, access the wealth that is sitting in the equity of their home without having to sell their home or finance with a traditional mortgage and a payment that they may not qualify for, then they realize, okay, this is the only way to do that. And then when they see how flexible it is, their minds start turning and they're thinking, what's going on here? What am I missing? Why doesn't everybody do this? And I think of it in terms of, if it cost $1, everybody would do it. Or if it were free, everybody would do it. If it cost $1 million, nobody would do it. Because again, if it's just a line of credit on your home and you don't even have to run up a balance, why wouldn't everybody do that? Well, there's a cost to it and there's limitations. So it's not so much what's the catch, it's just what are the limitations? And the limitations are you can only do this if you're 62 or over, right? There's no way I'm going to lend a 25-year-old hundreds of thousands of dollars that they don't have to make a payment on until they possibly pass away. Like it could last that long. There's no way that any financial institution is going to do that. It's not a sustainable thing. But 62 and older, it's available. Another limitation is you can only do it on your primary home. You couldn't do this on an investment portfolio, or you couldn't do it on a vacation home. It has to be your primary residence. And the next limitation is that there's a fee to do this. There's a cost. That insurance pool that we talked about, it's funded with a 2% upfront mortgage premium, which isn't necessarily cheap. It's probably going to be over $10,000 depending on the value of your home. Maybe a little less if you're living in a less expensive home, but it's a decent fee, and that's something nobody has control over. That's not a negotiable number. That's an FHA required fee that's paid when you do a reverse mortgage. And so you might think, well, if I live in a $800,000 home, that's a $16,000 insurance premium to get that reverse mortgage. That's just too expensive. And my response to that would be, well, compared to what? This is the only way that you can access equity in your home without moving or without getting a traditional mortgage. Yeah, there's a cost to it, but that's the only way that it makes it sustainable. And if I have an $800,000 house and I get a line of credit let's call it $280,000 or something like that, and if I'm 62, it could be higher than that if I'm older. But that, if I just open up that line of credit for a rainy day, it's consistently growing over the years. By age 85, that could be over $1 million. Based on current rates, it would be like $1.3 million. So having a line of credit for millions of dollars that has a low interest rate because your home is collateral, right? It's not a credit card. It's very low rate. And having access to that money, there's no taxes if I were to take the money and put it in my bank and pay bills or pay medical expenses or whatever. Or it might give me an option to take, if I have a big expense and all of my wealth is tied up in IRAs, I don't want to touch that IRA and if I need let's say I need a $60,000 distribution, or I need $60,000. If I want $60,000 out of my IRA, I might have to take out $80,000 or $90,000 to get that 60 because I have to pay taxes on the distribution. I could take the money that I need out of my reverse mortgage and fill it back up, pay it off, pay that line of credit off from my IRA distribution if I wanted to over 3 or 4 years to spread out that tax liability. And when people start thinking about it this way, those are the questions they start to ask is like, why doesn't everybody do that? Well, it's because there's a cost to it. And that's just the cost of doing that. And then the last limitation, I know I'm kind of rambling, then I'll shut up for a minute. But the last limitation is they don't let you do it on an unlimited amount of real estate. So you can't have a $52 million, ranch in Steamboat Springs, Colorado, and get, several $1,000,000 of a line of credit that works this way. They limit the value of the real estate you can do this on to about $1,150,000. I mean, it's currently less than that, but it's changing in January, and we're in December now. So in January, it'll be about $1,150,000. Now, that doesn't mean if your property is worth more than that you can't do a reverse mortgage. It just means they're going to stop their calculations after you hit that $1,149,850, I think is the number. It's really close to 1,050,000. Oh, yes. Shoot. But
I'm
yeah,
impressed though. Still, I had to write it down. So
so they just stop the calculations after that, and you don't get credit for the value that's more than that. They'll just run the calculations as if your property's value is that exact number. So those are the limitations on, yes, we want these to be available for people so they can access the equity in their home should they need to. But we're not just going to let it go to any amount of real estate for no cost and have, at anybody at any age. They have those limitations so that it's a sustainable model for people, or a sustainable system.
So a couple of points you brought up there, that's really good information. A couple of points you brought up there too. So the elevated cost compared to a standard mortgage, right? Like you said, it's not fair necessarily to compare it to a standard mortgage, but kind of sometimes we have to because it's tied to real estate. And so those costs can be elevated, like where a normal closing cost can be, somewhere between 1% and 3%, depending on the lender, depending on what time of month you close. Reverse mortgage costs can be a little higher, but another beautiful thing about those too is you can actually use the equity to pay those costs. So you're not coming to the table with your wallet out, pulling bills out to pay those costs, right?
Yeah, I've only seen one exception to people doing that. People always use the line of credit itself to pay for the reverse mortgage. I've only seen one person pay for it out of pocket.
Sure.
And another common thing that people, so we use that example where you're taking money out of or you need money, and rather than taking it out of your IRA, you can use this and then pay it off with your IRA. Another common example why people or another common mistake people make when they think about lines of credit and debt in general. First of all, we've been conditioned to think of D as like the 4-letter D word, like debt can never be a good thing. And that's just, it's too nuanced a subject to be that black or white about it. But think about let's say I do have money in my portfolio and I've got this line of credit and I need money, there's two places I can go to get it. I can use my portfolio or I can use my reverse mortgage. The mathematics don't really matter, because whichever one I use, if I use the reverse mortgage, that means, let's say I'm just going to use a simple number, $100,000, because the math is simple, although that would be quite a bit to need in one given sum. But maybe I'm using it to buy a vacation property or something, and maybe I do need a bigger lump sum. But if I need $100,000, if I take it from my line of credit, then I have that $100,000 liability that I now owe. Now it's collateralized by my home, so I'm technically eating into the equity of my home. But you have to remember that this is not an isolated concept. You have to understand the counterfactual, or the thing that was left alone because I used the reverse mortgage. So if I left $100,000 of assets in my portfolio because I used the $100,000 liability, then that's going to continue to compound in my investments that would not be there if I use that instead of my line of credit. Now, I'm not saying that you should always use a line of credit instead of other assets. What I'm saying is it's much less of an impact on my overall balance sheet than just looking at the amount that I owe. That's not the right way to do that, because I have to remember what money is still in my back pocket or still in my balance sheet over here because I use this. And when you start looking at it that way, it's a financial planning tool, which is part of the reason why there's been so much confusion about it. It is by far one of the most misunderstood tools on the market, because it's a financial planning tool that financial planners can't offer directly. You have to be a lender and you have to have a lender license and comply with the lending rules in order to offer it. So it's available through loan officers, but it's a financial planning tool. So it sort of exists in between those two worlds. You can either think it lives in a little bit of both, or it lives in neither. One way or the other. It's just not getting full attention because loan officers are not trained in financial planning and financial planners can't offer it. So it sort of sits in this place where it's available, but not widely understood for what it does by either.
And what's interesting too is I don't think, are you allowed to have both a loan officer license and a securities license?
Yeah, you can have the licenses, but it gets really sticky on, you have to justify and explain and have clients sign why you're having them do certain things, and you certainly can't use that. And now those laws are starting to change, by the way, what financial advisors can and can't advise in regards to your housing wealth. Wade Pfau had a big influence in that, and Barry Sachs, where they're saying, hey, if we're asking financial advisors to be fiduciaries and we're telling them that they can't take into consideration the client's wealth that's sitting in their home, that's putting their backs against the wall, because that's an important piece of their wealth. And you're telling our advisors they can't talk about it, but they have to be held to a fiduciary standard. Something needs to change, and they're making some progress with that. But people can be licensed. It's hard to integrate those two things because there's these rules and regulations in the finance industry that say you can't use housing wealth to invest in other things. I'm
And
really
that goes
broad
along
brush
with,
stroking that topic, so I know that there's nuance in there that I'm skipping over, but
yeah, we each have a CE class on that. And so it'd be great if you could attend those when you see them pop up on our feed when we advertise them. But anyway, yeah, you brought up some excellent points there. It's a financial planning tool, and that's really one of the goals of Lifetime Real Estate Advisors, to get you at that table, to speak confidently with, your CPA, your financial planner. So you're at that table, you are a lifetime advisor. You can help them with their first purchase and you can help them with their last. And if you understand the financial implications of that, the image problem that realtors have right now, you will overcome that obstacle. And it's a really important thing to do, because our clients expect us to be advisors. They don't want us to sell, they want us to be advisors. So,
yeah, that's a good point. I mean, we talk about this a lot, you and me, that a good lender and a good realtor are, well, good or bad. The help that lenders and realtors give people are some of the biggest levers, financially speaking, that people will ever have. And that can be good or bad, by the way, because if you're a bad realtor and a bad lender, the mistakes that you may make will cost the clients more than a bad accountant or a bad financial planner, because we're talking every real estate decision is at least six figures. Well, there's probably a few exceptions to that where they're under that, but there's 6 and 7 figure decisions almost always, and getting those right or wrong have a huge financial impact. So yes, we deserve to be at that table with in people's lives as advisors, equal magnitude or equal importance to their accountants, to their financial advisors and attorneys, but we have to earn that place, right? We don't just belong there because we have a license. If we take this stuff seriously and we add this kind of value to people's lives, that spot at the table really does make a difference in people's lives. We just have to earn it.
Yeah, it really does. And it's kind of hard to prove that and kind of hard to demonstrate that. Social media has given us all a microphone. And so that's one way to do that. But let's go back to reverse mortgages a little bit. I've found there's really three different types of clients in the reverse mortgage world that I've worked with. The first one is the old lady who has a paid off house, or the old man or the old couple who has a paid off house, and not much else. They're living off Social Security. If they have any retirement savings, any IRA or 401k, it's very minimal, right? And so they're really having to scrimp and save just to get by. But they have a fully paid off house. And so because maybe that's what they want to leave to their grandkids or their kids or whatever it is. And once they see the value, okay, this is immediately going to elevate my life right now. Great. The second one is on the other extreme of that. The very wealthy who understand this is a financial planning tool. And these are rare, but getting more common, thank goodness, because the word's getting out, I think, who can use this as a tool in concert with their other financial instruments, with their IRA, right? With their life insurance, with their annuities, with their long term care insurance. And that's really where they are most effective as far as boosting your overall financial wealth in concert with all of those things. So that's another different type of client. And then the third one is the one that's right in the middle, who is still really skeptical maybe of a reverse mortgage. Like, why would I get this? They're balking at the cost of closing costs of a reverse mortgage, that kind of stuff. And so it's really interesting to see the dynamics of each tier of those clients. Not tiers in terms of value, but just where they are with their wealth,
Categories,
right?
yeah.
Yeah. So do you have any experience with some of those higher end ones who you've helped see the light?
Yeah, so you know what's funny is I do a CE class for CFPs, Certified Financial Planners. And so far, everyone that I've done, I'm not saying that I'm amazing. I'm saying that reverse mortgages are just poorly understood. But so far, we're batting 1,000. Whenever we do a CE class for financial advisors, we get any well, in everyone that we've done, we've had somebody that qualifies because they're over 62 and they want to see a quote. They're like, I had no idea that it worked that way. I want to see, can you run my numbers? Let's get a quote. So, and then they also start thinking of clients that could use this. Again, not because in some cases they may not need it, but like you said, there's that strategy. Like if I can strategize when and how I pay my taxes on my IRA, or in some cases avoid paying taxes on IRA distributions, like they want to know about that. And if this can help them do that, they every time I've done a CE class for CFPs, we fill out applications and we do business because of it. That hasn't not happened yet. Because in many cases, they think they understand it because somebody did tell them, yes, it's a line of credit. You don't have to build up a balance. It's non-recourse. It's an increasing line of credit. But because lenders don't know how to use it in a financial planning context, and financial planners have never dealt with this kind of tool before. It's still fairly a new idea to them, or they're at least being opened up to the idea of using it in planning. They've not seen some of the creative ways that people will offset tax liabilities with them or preserve assets or timing. I don't mean timing the market in advance, but if my client needs money that we weren't planning for, like some medical expense that was outsized, that was large, that we didn't have a plan for, and they need money out of their portfolio, but the portfolio is, the market itself has compressed that portfolio due to a decline in the market. That's not a good time to take money out of a portfolio. They have access to this line of credit that is hundreds of thousands of dollars. It gives them so many more options. And once they see it for what it is, they're like, oh, this is actually a pretty cool little tool. So that
Yeah,
that happens all the time. I would still say the vast majority of reverses that we do are the people that need them, because those are the obvious, they call, right? They're the ones that are the most obviously in need of it. The financial planner, it's a little bit longer of a sales process because they see it in the CE class and they're like, that's amazing. And then they talk to their clients, and now that you're playing that phone game, and even though they might be excited about it, they're not saying it from our perspective with the experience that we have in it. And then the client's like, yeah, but I heard reverse mortgages were this or that. And then the financial planner has to end up saying, no, just trust me. Let me have you talk to this guy to learn more about it. So it's just less direct. So still, the majority of them that we do are the people that really need them. And I have no problem with that, because that's who I like helping the most anyway. They're the ones that need the attention. But people with money, they can use these in very creative ways.
You found too, with clients that I've done consultations with for reverse mortgages, the rubber really hits the road when you do their own numbers,
Yeah.
right? And so one way to get a financial planner to do that is give them a simple sheet. All we ask for is like, I don't know, 6 items. We need their birthday, we need their how much equity they have in their property, those kinds of things. Not really a lot. And so once we do that, they can kick them to us. We can kick them out of a scenario very quickly. Be like, okay, here's the scenario. Here's what you could do with this. And once they see their own numbers in them, that's when it connects with them. They'd be like, oh, you can do what with this? This is
Mm.
what it's doing for me. It's at in 20 years, it's going to have this line of credit is going to be worth how much? It's really powerful stuff.
Yeah, you know what blows people's minds, and this kind of explains why that insurance policy is necessary, is that the line of credit itself is still available even if it's bigger than the value of the home. So let's say you get this line of credit started at age 62 and at age 90, it's worth $1.5 million. And let's say you haven't put a balance on it. I mean, you got a couple $100 on there because that's required. But interest on that is $10 a year or something stupid. So
Yeah.
and by age 90, that line of credit is say $1.5 million. That's very, very plausible. That's a very reasonable expectation. Well, let's say that at that time, the home's value, because of a soft real estate market, it just doesn't appreciate the way we're expecting. The home's value is only, $1.1 million, but your line of credit is $1.5 million. Can you take that money out and put it in your bank account because it's a line of credit? The answer is yes. Isn't that
Yeah.
crazy? Like, and you don't
Yeah.
even, it's not like you even, there's so much utility to that, because that would mean, so if I was, let's say our parents were in that situation, and they were in that situation where they had the line of credit worth 1.5, but the home was worth 1.1. And let's say, you know what, I'm feeling a little bit old. I think I need to go into a nursing facility. I need some help. I think I'm going to sell this property. Now, because there's no balance on the line of credit, there's nothing to be paid if they sold the home. So if they sold the home, they'd get that $1.1 million. But what we would do in that situation is we'd say, dad or mom or whoever's, left, we'd say, whoa, 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 whoa. Don't sell the property yet. Max out the line of credit. Put that $1.5 million in your bank and then sell the home. Now you won't get any equity in the home because you already took it out through that line of credit, but you put in your pocket $400,000 that you would not have gotten by just selling the property the way it is. Now, again, I'm not predicting that will happen much because they build these things so that is unlikely. But the fact that that could happen, that's an insurance policy that can be selected against. Somebody could see they're taking advantage of that several $100,000 difference, run it up and do that. And that could be you if you have the reverse mortgage. So that's why that insurance pool exists. And that opportunity to do that cost that client in the beginning, a $15,000 or a $16,000 insurance premium to make sure that was a sustainable thing. But that's how it works. It's not just if the balance goes up, that line of credit, even if it's larger than the value of your home, you still have access to it, which is mind-boggling. I don't know any other line of credit or any other financial tool for that matter that works like that.
Yeah. A HELOC you have to pay back every month, right? Every month you have to pay the interest on it, right?
Yeah, and
One
they
of the
can
things
call those.
yeah,
They
they
can
can
say,
call those.
we
You
don't
cannot
like the
call a reverse
equity.
mortgage.
Yeah, we don't like that buffer of equity that you've got anymore. Real estate's been soft, rates have gone up. We're going to restructure this HELOC. This doesn't work that way with HECMs. Once you get it under contract, the terms are set and it just goes.
Yeah. I wanted to refine a point you had on there is having that line of credit build. Some people think it's a better idea to take out a reverse mortgage if they're going to do it at all, to take it out later in life, like at age 75 instead of 62. But you just kind of talked about why it's a great idea to get those as early as possible, because the earlier you have it, the longer that line of credit can grow, right?
Yeah, so there's two things that you would balance. If I get it at 62, I start that line of credit growing. But if I wait till I'm 63, I could borrow a larger percentage of my home, assuming that interest rates are the same. It's possible because the older I get, the higher that percentage, they call it the principal limit factor. But the higher that percentage of the credit limit that I can get based on the value of my home. So if once you understand how these work, you start thinking, okay, well, I have a larger line of credit by opening it now and letting it start growing, or by opening it later and having that just be a higher percentage of the value of my home. And the answer is we don't know that because it depends on a few things. It will depend on your age, but that's predictable. You're going to get a year older every year. The two things that aren't predictable are what will rates be when you need the money, and what will the value of your home be during when you need the money. Now we can project, a 4% increase on the value of your home, or 6 or 7 or 4, or whatever, 3. We can project however that will be and tell you what your principal limit factor will be based on guessed interest rates. But I think it's like 76% of the time. I'm quoting this from memory from Wade Pfau's book. 76, it's in the 70s, about 3/4 of the time. You will never have an opportunity to get a larger line of credit later. But there are circumstances and historical precedents where markets went up, rates went down, causing you to get a higher value. We're getting into the weeds here. But the thing is, you're probably going to get a larger line of credit by starting earlier. But in the cases where you don't, in the cases where it would have made sense to wait and get a higher line of credit at age 81, because that's when the markets for real estate went up and that's when rates were low or whatever, you can always refinance and increase the line of credit, and it doesn't cost you that same 2% premium again. So it's a reversible, or you can Monday morning quarterback that call as long as you have it in place first. Right. You can't Monday morning quarterback that if at age 81, you have way less access to equity than you would have had you started at 62 and it grown. You can't say, well, I want to go back in time and have that in place. The best way to get the best opportunity is do it now. And that will likely be the best line of credit you'll ever get anyway through the growth. But in cases where it's not, you can refinance and boost. Now, refinancing does cost something, because there's still going to be an appraisal, there's still going to be a loan officer, and some papers being passed around by humans that are making a living doing that. But it's not near the cost of doing it the first time, because that insurance premium, you get credit for having paid that before. You may have to pay an additional insurance premium because you're asking them to increase the line of credit. So there will be an associated cost with that, but they'll give you credit for the line of credit that you established in the beginning.
Exactly.
So the wisdom is do it earlier, because you can always change your mind if things improve for you. You can't always do that by waiting. Well, you can never do that by waiting.
Yeah, it gives you options. So I wanted to talk next about how this can be a retirement savings. So home ownership, I mean, we're big proponents of of home ownership being a central and early piece of your financial planning, right? Because of how much the leverage helps you, how much it grows your personal wealth. And it's a shame that so many financial advisors, if they can talk about it at all, they do so very vaguely, and maybe an obstacle to get around. Maybe a goal as far as something to have, as far as, I want to live in a nice house.
Let me throw something in there, because I think financial planners don't ever talk about that, not because they can't, because they can make recommendations like, hey, you should own your home, or they can help you know when to pay it off. But as a financial advisor, I can't think of a single time. There might have been some that I've forgotten, but I can't think of a single time that somebody who didn't own a home approached me. Right? I didn't help people that didn't have money, because that's not what financial advisors do. I know that's weird. I think we should figure out a business model where financial advisors can help people that don't have money, but that's a big problem to solve. But as a financial planner, it was really rare that anybody, and you could think of which is the cause and maybe it's just a correlation, but I think to myself, it can't be an accident. People don't have money to invest with retirement planners and financial advisors if they don't own their home usually. It's just rare. I'm sure there's some exceptions to that, but for the most part, owning your home is like the first financial step that people make to give them money to invest later, because they've fixed a very big portion of their expenses, rather than that increasing with inflation over time. They've set that, and then every time rates go lower than what their current rate is, they get to knock that down, which is a complete opposite of what happens with rent. It's just constantly increasing. So they put that part of their lives in order, and nobody, either their parents told them or friends told them, or they just figured it out and they did that on their own. And then they had wealth later on and they contacted a financial advisor. So financial advisors just don't often have that conversation, because they're not very commonly dealing with tenants.
Yeah, and that's actually one of the reasons I got into real estate like you did, is because I noticed over and over my clients, well, the difference between my clients who were struggling and those who were comfortable and even wealthy was almost always real estate. And I'm not saying that's the cause, but it definitely was at least the effect. So, and if you have done that, and if you bought at a reasonable time and you have equity, you can't do a reverse mortgage if you don't have a significant amount of equity, usually, especially if you're trying to go earlier. Because if you're 62, our parents just bought a home. They closed in September, and the youngest client which is what they base reverse mortgage numbers on, the principal limit factors, that kind of stuff. Our mom is in her mid 70s. They put around 55, 60% down. Now, they use that from the equity of their old home, but if they didn't own their home before that, Like that would be really hard for people to just save up over time,
Yeah.
while they're renting, right? Because renting keeps getting worse and owning keeps getting better over time. So
Well, and the truth is over the time frame of even 30 years. So let's call it a 30-year time frame, which is for most people listening, that's probably too little time to be thinking about, right? We need to all be planning our finances out till age 95 or 100. But let's just pick a 30-year time frame. It costs less to own a property over 30 years than to rent one anyway. It starts out costing a little more, but
yeah,
but the mortgage is fixed and you have the taxes and the insurance. That's the only part that's creeping up. But you pay off that mortgage and keep the property in decent shape, you're going to spend significantly less money over time than renting a similar property. So not
right.
only does it cost less, you have something at the end that's worth something. You could use the equity in that through a reverse mortgage if you need to, or if you want to. Like there's just so many benefits to home ownership that are being ignored when like the New York Times and the Wall Street Journal wrote a couple of articles in the last
Yeah,
couple
they're
of weeks.
attacking it, right?
Yeah, and I mean, you see that once and you're like, man, that must have slipped through the editing at the New York Times. And then you see an article from the Wall Street Journal 10 years later, and it's like, that feels like an agenda. That's just too much that's
10
too
days
much.
later.
Yeah, I'm not a conspiracy theorist, but I have a hard time looking at that and thinking that they're not connected. Like
Yeah.
it reminds me of that, that I forget who was it that said this, but they said something to the fact of, you'll own nothing and you'll like it kind of thing. Like
Yeah.
we know what's best. We're in charge. We're going to own everything. You just pay us a portion of your income every month to give us what we're giving you while we get wealthy. Like again, I'd like to think that those were two just coincidences. That's the way I want to live. That's what I want to believe. But I have a hard time looking at that and thinking that that wasn't coordinated. They're saying,
Yeah.
oh, it's expensive. It's too expensive to own a home. You should rent instead. Like, I can't believe that that slips through two major public, especially the Wall Street Journal. Like, they should know money better than that.
Mhm.
Homeownership is not, you can't treat it like the stock market because you can't live without real estate. You're going to be paying for it regardless. You may as well own it
Yeah.
instead of buying it for somebody else. And people that will say, well, if you're renting, you don't have to pay for maintenance, you don't have to pay taxes and insurance or HOAs. And it's like,
Yes, you
what
do.
world did you grow up in? That isn't the way it works at all. That's like saying if I buy a Snickers at Walmart, I don't have to pay for the chocolate or the wrapper because Walmart paid for all that stuff. And it's like they're passing the cost on to you, idiot. That's how it works. I didn't mean to say idiot, but like what I mean is it's always
Right.
baked into the cost that the consumer pays, always, in addition to some profit. So there's no way it's
Yeah.
going to cost you less to rent over a lifetime than it costs to own. That could happen in short periods of time as markets fluctuate, but over a lifetime, it's ridiculous to think that you're avoiding the cost of housing by renting. It's all baked into the cost.
Yeah. So, yeah, again, home ownership makes it possible to get a reverse mortgage and to access all these wonderful tools that you can do with it. We didn't bring up the tax savings and tax strategies of it, which can be mind blowing. Every time I even talk to reverse mortgage loan officers who don't know you can offset a 1099 with a big old fat 1098, they get their minds blown, and I love it. Um,
That's another
but I
testament to the
wanted to
fact
go,
that like lenders and financial planners, this lives in the middle, right? Lenders who should
yeah, yeah,
know, they would, as soon as you explain that that can be done, they go, oh, of course. But they never think of it in a financial planning context. I shouldn't say never, they're just not trained to. And financial planners who are always thinking about financial contexts, they're not plugging reverse mortgages into how that can be used in financial planning. Sorry, I didn't mean to
yeah,
interrupt.
I agree. No, it's okay. So I wanted to kind of cap this episode off with another story of a man we helped. It was a family, actually. It was a son and his widowed father or widower. I forget how that term works out. Anyway,
I wonder if we,
he did not have his wife anymore, who had died, and his son was helping him buy a fourplex, and he was just going to buy it and own it as an investment property. The son was, and he was just going to have his dad live there. I'm like, have you considered buying that with a reverse mortgage? It's like, why would I do that? It's like, well, he can live in one of the units if he is involved in the transaction, he's on title and everything like that. It's clean. He can live in one of the units, rent out the other three, and not have a mortgage payment. We ran some calculations for him, and he ends up cash flowing like $2,300 a month. He didn't have much retirement savings, but he was getting Social Security plus $2,300 a month. Like, yeah, there's some really amazing things you could do with these.
yeah,
So
like the HECM, which is again like 98% of reverse mortgages are the HECM. It's the FHA version of the reverse mortgage.
Right.
It's an FHA loan. So for anybody out there that knows FHA and traditional FHA loans, you can use it up to a fourplex. It doesn't have to be a single family residence. You could do a duplex, a triplex, or a fourplex with that. And depending on the market, because that limit of 1.15 million, you may not be able to buy a fourplex in like Boulder, Colorado or something for,
Sure.
to fit under that amount. But maybe a duplex somewhere out in the outskirts of town, um, just depending on the market. But it's a really clever idea of ways I can collect income from a tenant and have no mortgage payment, even though I used a mortgage to purchase the home. It's pretty flexible and amazing.
Yeah. So anyway, that is a very small snippet of what we can do with reverse mortgages. And thanks for tuning in this week. We will come back next week, and I hope you all have a excellent holiday season. Thanks for tuning
Yeah.
in.
Good to see you, Dan.
Hey, you too.